The one thing I can't buy you is time. We have the Roth IRA and the traditional IRA. And the requirement here is that we have a pulse and we have earned income. That's called tax rate arbitrage, where we deduct at a higher rate than we include. So we're essentially printing money off the government, right? We say, hey, government, first give me 24 cents on the dollar, and then years later, I'll give you 12 cents on the dollar, right? That's effective tax planning. Moses did not come down the mountain with an 11th commandment stating we shall always have qualified dividend income rates. And he also didn't come down with an 11th commandment stating we shall always live in a low yield world.
Hi, and welcome to Catching Up to FI, a podcast on mindset, money, life on the journey to financial independence. I'm Bill, and I'm a late starter.
I'm Becky, and I'm also a late starter, and we're your hosts. We're here to help you with your journey to financial independence, no matter where you're starting from.
We're going to talk to other late starters, experts, and we'll explore topics related to our mission.
Join us as we catch up to FI together.
Hello, and welcome back to Catching Up to FI. I'm Bill Yount with Becky Heptig, my co-host, and today we have an exciting guest for you. We're going to talk about taxes, life and taxes, not death and taxes, and how you can take advantages of retirement accounts. How are you doing today, Becky?
I'm doing great, Bill, and I'm excited about today's guest. We're talking to Sean Mullaney, who is also known as the FI Tax Guy. Sean is a financial planner, and he's the president of Mullaney Financial and Tax, Inc. At Mullaney Financial, Sean offers fiduciary, fee-only, and advice-only financial planning. Sean speaks, blogs, writes, and he's been a guest on multiple podcasts, such as Choose FI, The Stacking Benjamin Show, How to Money, and Earn and Invest. And he blogs on tax and financial independence at fitaxguy.com. And Sean, I have to tell you, I never see fitaxguy.com without seeing the Fit Axe Guy. So to me, you're the Fit Axe Guy. In 2022, Sean wrote the book Solo 401k, the Solopreneur's Retirement Account. And Sean and I have known each other for a while. And Sean, I can't really remember when we met in person. I know I heard you several times on the Choose FI podcast, but Sean and I have been to Camp FIs and Economy, I don't know, maybe a couple of years ago.
I would bet money it was probably at a Camp FI out here in Southern California. That would be my guess, because I know we've attended at least two of those together.
That's true. Sean's a great contributor to the FI community with his wealth of tax knowledge. And I have to say, Sean, that you are one of the few people I know that can have a tax conversation and you not want to go, okay, can we just do this later? This is boring.
Well, thank you for that high praise, Becky.
Sean makes taxes interesting. So Sean, welcome to Catching Up to FI.
Bill, Becky, real pleasure to be here today.
No, it's awesome, Sean. And thank you for coming to join us and talk to our community of late starters. You wanted to start with the big picture. What do you mean by that?
Yeah, so let's think about someone who might be catching up to FI, right? Meaning essentially they're late by now we have conventional financial independence standards, right? But they're sort of late to this retirement game. And what are we going to do? What do we do from a tax perspective? And so I have a few thoughts on that. First of all, when you're late in the retirement savings game, it's all about sufficiency first, right? So your main goal is to get to a position where you will have sufficient assets and income to support retirement at some sort of desired age, right? In theory, I'll keep working, you can retire at 90, but that's not really the outcome you're going for, right? So you're going for sufficiency at a decent retirement age. Okay. Well, what that means, though, is that tax planning is a secondary priority at best, right? We got to get to sufficient assets and income before we worry about tax planning. Okay, so that's the first point. But here's the second point. The sufficiency planning actually very naturally dovetails with tax planning. So we'll talk about this in a little more depth, but when you're sort of later in your career, so, for many people later in their career, they've been around at that employer, that occupation for maybe 20 years. They've got some reputational value built up. So they're at their highest earning years in their career, but for whatever reason, they weren't attentive to their finance, there was a family issue, whatever it is, they're behind in the retirement savings. So we have a high income and a high tax bracket today, and we're trying to get to retirement, we're behind. Well, guess what you probably should be focusing on? Tax deductions, right? We'll talk about 401ks and things like that. So the tax planning in that situation becomes, all right, I'm trying to build up my assets. How do I build up my assets in the quickest fashion? And the best way to do that in the quickest fashion usually is deduct, build up those traditional 401ks, all right, so that we're using our tax planning to get to sufficiency. But here's the thing, if we're really behind in retirement planning, we're not likely to be in a spot where, oh boy, I get to retirement and now taxes are killing me, right? We have progressive tax brackets. We could talk about that in the drawdown phase. But what happens is you get to retirement and your income, generally speaking, goes down. Hopefully, we're still sufficient. And because of the progressive tax brackets, right, the standard deduction, the 12% or the 10% bracket, 12% bracket, you're usually not going to be hit that hard by taxes if you're coming into this from a catching up to five perspective. So we'll put more meat on those bones. But I think the two main points are we want to prioritize sufficiency. And, oh, by the way, doing so when we're behind actually is usually pretty good tax planning.
All right, that sounds great. We do want to get into meat of this and put some meat on the bones, as you say, and tell people, or at least educate people on the vehicles that they have at their disposal to reach sufficiency. So let's go through a little bit of the basics of retirement accounts and start with what you may have at work.
Yeah, so I think folks get confused about IRA, 401k, 403b, profit sharing. I'd like to start with laying it down a paradigm of two types of accounts, at work and at home, right? And so if we think about it that way, we're going to, I think, be able to understand this a little better for those who are new to these concepts, right? So what we're talking about is tax advantage accounts. We have them at work and we have them at home. So when we're talking about at work, the main one is the so-called 401k. And that has two components, right? Employee contributions. If we're 50 or older in the year 2023, we can max out at about $30,000. So that's a very powerful number. That's the big one. Some folks might have a 403b, 457. These tends to be nonprofit, governmental type employers. Some folks have pensions. Those are all tax deferred too. But when we think about at work, when we have, hey, maybe up to a $30,000 tax deduction we could get, that's a good way to build up wealth and get tax deductions, right? So maybe the idea is, hey, we're behind, but we're in the 24% tax bracket, 32% tax bracket. Well, if I put my 30,000 in there, multiply that by 24%, 32%, that's the tax savings I get today, a real benefit. And oh, by the way, I've built up $30,000 in tax deferred wealth. So that's a good way of going. And Bill, you and I were talking a little bit before the show, not everybody has a large W-2 employer. Some folks are self-employed. And there is a self-employed version of the 401k. It's called the solo 401k. I wrote a book about that, as Becky mentioned, last year. And that can be very impactful for a number of reasons. One, they're generally low fee plans that are very well diversified in terms of investment choice. And two, they have these high contribution limits, that 30,000 if we're 50 or older. And oh, by the way, you can also do an employer contribution to that solo 401k. And that can be a very high number the way the math works out on that. So 401ks, I think, are going to be, whether we're self-employed, large W-2, mid W-2 employer, are going to be the large driver of, that's step one of getting to sufficiency when we're behind in our retirement savings.
And so I think you have a little bit of a disadvantage as a W-2 employee in this regard, because the employer match is only 3 to 6%, maybe 10%?
Yeah, so that's a great point, Bill. So the employer match is limited by two things. One is the tax code, right? So the tax code says, well, you can only put so much in there, employer. But two is just the competitive market and the cash flow of your employer, right? So your employer doesn't exist just to build up huge retirement accounts for you, right? They want to be competitive. They want to attract you to the job, but they're also not going to just throw in $30,000 as an employer contribution, even though maybe under your salary, the tax law says they can. what do I see typically? I might see, maybe 6% of salary is matched 50%. Maybe it's 100%. Maybe it's 25%. Do some math there, right? If you're making 100,000 W-2, say, and you get, say, 5,000 as an employer match at a large employer, you're doing pretty well vis-a-vis a lot of other people. Well, what if we were in a solo 401k situation, right? So there we can say we're making 100,000 Schedule C income. That's the tax form you report your self-employment income on. There you're limited by the tax law and your own cash flow. So it's your own desire. So, that W-2 person, large employer, $100,000, if they get $5,000 employer matched, they're doing great. Well, you as a solopreneur, right, you could do up to $18,500, it's actually $87 as an employer contribution in addition to the $30,000 if we're 50 or older, right? The only limit there is your own desire and your own cash flow, right? If you don't have the cash flow to fund, in my example, over 48,000 into a solo 401k, well, then you can't. But still, it's nice to know that that limit is there. And the only limit really is your cash flow and your and the tax rules. But the tax rules are very generous in that regard. So, if we're working for ourselves, that is a big advantage, is we get to define the employer contribution, not our employer. So that's a nice thing.
At what income do you reach the max limit that you're able to contribute? I am at that. My wife is not quite there. And to show you the power of this solo 401k, we are able to, in our joint income situation, save roughly $140,000 a year in our solo 401ks. But what income are you able to start saving the max?
Yeah, so I haven't for 2023. I think, well, for people who are under 50, I have this in my book, and this is actually for 2023. It's on my blog because I posted a little update for 2023. For people who are under, I'd have to double check this, but it's going to be, to max out a solo 401k, it's going to be in the low 200,000s of Schedule C income, and it's even lower if you're a so-called S corporation. It's not that. It's not as high as you would think. You'd think like, oh, I'm going to have to make $500,000 to max out my solo 401k. Absolutely not. There's a blog. I'll send you guys for the show notes my 2023 update on solo 401ks. And I think the answer is it's actually the same. And it's a number in the low 200,000s. It's pretty remarkable that you could, if you're 50 or older and you make sufficient income, which, like I'm saying, is about somewhere in the low 200,000s, you could get 73,500. That's the all additions limit, right? So there is a limit. We can't just make $10 million and put $5 million into a solo 401k. There is an all additions limit. If you're 50 or older, it's 73,500 for the year 2023. But you reach that from an income perspective at a relatively modest number. It's on my blog. It's in the low 200,000s. All right, so on the 403Bs and the 457s, these are different types of employers, and the rules can get a little complicated here, but here's some rules of the road to keep in mind. That $30,000 I mentioned, that is per person. That's per human being, not per employer. So say I have a W-2 job at a large employer, and then I have a side hustle, okay? Between my W-2 job and my side hustle, I can get $30,000 as an employee into 401ks, 403Bs, and solo 401ks. Interestingly enough, the 457 has its separate limit. So if I have a 457, and some people even have a 403B and a 457, or a 401k and a 457, those sorts of things exist in the world. So you can actually double up if you have a 457. The 457 does not share that limit. They have a limit that's the exact same dollar amount, but they don't share that limit. It's a little weird. So if you have a 457, that's a clue like, okay, I need to think about additional tax planning. The other thing about the 457 that a lot of folks like is, generally speaking, the 457 does not have the early withdrawal penalty. Depends on where you are in life, right? So if you're not planning on retiring before age 59 and a half, that's sort of an academic, okay, this rule exists, but I'm never going to use it. But if you are thinking about retiring before age 59 and a half, that could be an attractive feature of the so-called 457. And I know 403Bs have this is something I've not gone down the rabbit hole. They have some complicated catch-up provisions that can apply. It's interesting though, that 30,000 for those 50 and older is generally shared among solo 401k, regular 401k, and 403b, but not shared with the 457. So if you've got especially a 457, you're going to want to think about some additional tax planning if you can afford it, and if you're behind from a sufficiency perspective.
That's great. I really appreciate that because it does get pretty complicated. And folks that have both of those accounts have additional strengths in catching up. So it's good to know those things.
So we talked about the retirement accounts at work. So let's move to what do we have available to us at home?
Yeah, great question, Becky. And so this is the second piece of it, right? These are separate and distinct. At home, we have the Roth IRA and the traditional IRA. And the requirement here is that we have a pulse and we have earned income. And that's either us or it could be our spouse, right? Either one works, right? So maybe we have a stay-at-home spouse. Okay, fine. But then the other spouse goes to work and they have 100,000 of W-2 income or self-employment income, whatever earned income they've got. Then both spouses can make a Roth or a traditional IRA contribution. I like individual retirement accounts because they're easy to administer and you have a plethora. You have the world in terms of financial institutions, investment options. It's individual. You decide, okay, I like financial institution A, I like financial institution B. You make the decision, not your employer. The one of the downsides is we have more modest contribution limits, right? So I was alluding to the 30,000 if we're 50 or older, plus we have employer contributions. On the IRA and the Roth IRA, the contribution limit this year for 50 or older is $7,500. Look, $7,500, if I put that money on the table in front of you right now, you'd scoop it up pretty quick. But where I come from also, 30,000 is a lot more than 7,500. So definitely an opportunity there. And if we're doing maybe a spousal or both spouses work, now we're up to 15,000 if we're both 50 or older. And then one thing to keep in mind about IRAs, people get confused about this. Oftentimes, an IRA, so a traditional IRA, which is the mirror image of the traditional 401k, or a Roth IRA, which is the mirror image of the Roth 401k. Oftentimes, these IRAs are the retirement homes for the workplace retirement accounts, the 401ks, the 403bs, those sorts of things. Oftentimes, look, you got to think about this, but many times what folks like to do is they like to say, well, I'm retiring or I'm leaving employer A, so I'm going to take my old 401k from them and I'm going to transfer it. Generally speaking, we like these direct trustee to trustee transfers, but I'm going to transfer it from that old workplace retirement plan to an IRA, to a Roth IRA. So the IRA serves as its own retirement home for workplace retirement plans. Folks like to do that mostly, right? You have to assess your own circumstances, and there may be times where you want to keep it in the old workplace plan. But it generally speaking, gives the investor more control because now they pick the financial institution, not the large employer.
Let's circle back for a minute to the solo versus traditional 401k, because one of the disadvantages of the workplace 401k can be limitations of investment choice and higher costs versus the solo 401k. Can you address that a little bit, the cost perspective and the advantages perspective?
Yeah, sure. So at work, your employer adopts a 401k plan. They contact a benefits administrator. They contact a financial institution. It's up to them. And essentially, it's you log into your account. It says Bill Yown, and it has your balances, and you think you're the client. But really, if you step back, well, who's the one engaging that financial institution? Who's the one engaging the benefits administrator? It really is the employer, right? You didn't pick the financial institution. You didn't pick the benefits administrator. And the investment menu is generally the investment menu, right? Well, let's think about a solo 401k for a second. These days, many of the large financial providers, financial institutions out there offer the solo 401k. And, I'm not in that business, right? I'm a financial planner. I don't know exactly why, but I see if you look at the large financial institutions, the fees on solo 401ks are generally speaking very modest. Some of them basically have zero fees. And then they say, well, you have to pay the investment fees inside the mutual funds. But those then, if you do index funds, oftentimes those are very small fees. My theory on it is it's sort of a marketing thing for the large financial institutions. They say, oh, these self-employed folks, they'll build up solo 401ks and then they'll retire or they'll go to a large employer or whatever they do. And then those become traditional IRAs with us. And now we have a customer for life. And I think that's what they're trying to do. That's just my speculation in terms of their business model and why they have such low costs. But it's a nice thing. They have low costs. And oh, by the way, they have very large investment menus with all sorts of options that can be very low fee in terms of investment fees. So the solo 401k, one of the real advantages is it sort of puts power back in the investor, because now the investor is the client. They're the one picking the financial institution. They're the one who gets to determine the menu of investment choice.
Yeah. For example, I'm at Vanguard. That custodian is awesome. And the fees are very minimal and only the fund fees. And as long as you're in passive index funds, it's 4 basis points, 10 basis points on these funds, and the costs are minimal. I would talk to others and say that Fidelity and E-Trade are other options in this big box arena. Becky, who are you with?
Our investments are also with Vanguard and mostly in index funds. So we also have the 4 basis points cost.
Yeah, let me, I'm not here to provide investment advice or to endorse any particular institution. My understanding today, and you go to the website and maybe, my understanding could be weeks or months out of date, or they could literally change as we're doing this episode. My understanding on Vanguard was that they charge $20 per fund per year in the solo 401k, but they waive it as long as you have $50,000 of assets in Vanguard. So that's going to be a lot of folks, right? They just have brokerage accounts, old traditional IRA, whatever it is. So, $20 a year doesn't strike me as all that onerous, but it seems like it can often be waived. You got to do your research. Hey, Vanguard may have updated their fee schedule, or I may just not be recalling it correctly. We're recording in the AM, so maybe I need another cup of coffee. But there you go. But the broad point obtains, right? Regardless of the exact nature of Vanguard's fees, the large financial institutions tend to offer these solo 401ks at very affordable prices, which is a good thing when we're self-employed.
Sean, I have never had access to a 401k of any kind. So if you are a solopreneur, then and we're talking about Vanguard, I'm assuming that the other major brokerage firms would be options also. Can you set up your solo 401k at Schwab or Fidelity or?
Yes. So to my knowledge, all of Vanguard, Fidelity, and Schwab, among others, have solo 401k programs. Now, it's interesting though. When if you're self-employed, you got to ask yourself some questions before you set up your solo 401k. One of those questions is, do I run a Roth 401k? Now, I think for those who are largely behind in the game, oftentimes you probably don't want a Roth 401k in your solo 401k, but you do you got to do your own analysis, or maybe you're listening and you're like, I'm not behind, I'm doing great, I actually want more Roth, right? Whatever it might be. My understanding today, and again, plans change, right? My understanding today is that Vanguard has both the Roth and the traditional in the solo 401k, and Vanguard and Schwab only have the traditional in the solo 401k. To my understanding, again, check their websites, is they don't have the Roth today. So if you're looking for that Roth solo 401k and you go to, say, Schwab or Fidelity, you're like, oh, I like certain things about this, but they don't have the Roth and I really wanted the Roth. Well, okay, great. That means because of your particular preference, that's going to be off the table. So that's one thing to look at. The other thing to look at is if you're self-employed, there are different rules in terms of having other employees part-time. Vanguard basically says, look, if you have a part-time employee for a minute, an hour, anything, you don't get to participate in our solo 401k. Now, there's exceptions for business partners and spouses, but outside of that, if you're at Vanguard, you don't get to do the solo 401k there if you have one employee for 1 hour a year, right? But my understanding is Schwab and Fidelity, you can work with them in terms of the contours of the plan where certain part-time employees could work in the contours of their plan. So you just got to do your due diligence with respect to each plan, because each plan has slightly different rules in this regard. And you just want to make sure you understand your business operation and what their plan offers.
Can we zoom out for a minute, because we may have gotten ahead of ourselves? And we've got the traditional 401k, we've got the Roth IRA, and then we've got taxable brokerage accounts. Can you talk a little bit about the tax implications, advantages, and disadvantages that people need to be aware of with these accounts?
Yeah, sure. So traditional accounts, right? This is from a retirement planning perspective in the last, this is mostly my lifetime, right? The last almost half century now. Folks love these traditional accounts, right? Because we take deductions when we contribute to them, great. And then, yes, they do have to come back in income when we take them out to fund our retirement. But usually, in most cases, most Americans in their retirement will be at a lower tax rate than they were in their highest earning working years. So the idea is take a deduction while you're working. Hopefully you're in the 24% bracket, 32% bracket, but maybe even the 12 and 22% bracket. And then in retirement, you take a distribution to live off of. You do something maybe called a Roth conversion. We'll talk about that later. And you put that money back into your taxable income, but maybe only at a 10% rate or a 12% rate. That's called tax rate arbitrage, where we deduct at a higher rate than we include. So we're essentially printing money off the government, right? We say, hey, government, first give me 24 cents on the dollar, and then years later, I'll give you 12 cents on the dollar, right? That's effective tax planning. That's what we're trying to do here. That's all we're trying to do. And that's why folks love these traditional retirement accounts. And they're really good, especially if we're trying to catch up to FI, where what we could do is take that 24-cent benefit from the government and then invest in a taxable account on the side, right? We can sort of do both when we're catching up to FI. We max out, say, the 401k at work, then take the tax savings and invest them in a taxable brokerage account. Well, that's the second account. That's the I own it in my own name, taxable account. We live in a unique era in terms of the last century or so of American history, where taxable accounts these days are not that bad. Now, it sounds terrible. Oh, this is tax. Nobody wants a taxable account. But we have a few things going for us circa 2023. One is very favorable investment tax climate. So what I mean by that is you get a dividend from stocks, a lot of equity mutual funds, and you don't pay your normal ordinary income tax rate. You usually pay what they call a qualified dividend income tax rate. Not always, but usually. And so what that means is, you might be in the 24% marginal tax bracket, but you only pay 15% on that dividend. Or maybe you're in the 12% marginal tax bracket and you only pay 0% on that dividend, right? They call them favorable qualified dividend income, long-term capital gains rates. So that's really good, right? Essentially, investment income today in today's environment is really good income to have. The second piece of this is we live in a low yield world. And for those catching up to FI, you actually may remember a not so low yield world. So if we go back to, say, the early 1980s, right, you had bond funds, say, and they were paying 10% interest, 12%, 15% interest. Well, that's sort of nice, but it's sort of terrible, meaning I own $100,000 in a bond fund that kicks out 10, 12, 15,000 of taxable income to me every year. That stinks. Well, in recent vintage, right, what happens with those taxable accounts is they're only yielding 1, 2, 3%. So now I own 100,000 of some equity mutual fund, and it kicks out $1,000 of dividends a year, $2,000 of dividends a year. So I got to put that on my tax return, but that's not that onerous. And oh, by the way, it probably mostly qualifies for this 15% qualified dividend income rate. So I'm combining a low yield world with a tax advantaged investment climate. And these taxable accounts are not that bad. So I think, that's something people underestimate when they're thinking about their retirement savings as well. Probably having some taxable accounts to live off in the beginning of my early retirement or even conventional retirement is probably not that bad of a thing. And then I'll touch on the Roth, right? The Roth, we love Roth because it's tax-free growth, right? So Roth is the flip of those traditional accounts. This is the third leg of the tax triangle, right? So we don't take any tax deduction on the way in, but it's tax-free growth. A lot of folks are going to have large Roths in their 70s and 80s, so they aren't taxed that much on what they call required minimum distributions. That's a required distribution from those traditional retirement accounts. We don't like those because it creates taxable uncontrolled income. So what we do is we get to retirement and maybe we do some what they call Roth conversions. We affirmatively move those traditional accounts to Roth accounts. We pay a little tax usually, but now we have tax-free growth, and we elected to pay tax when we had artificially low income. So these three can work together. We'll talk about distribution planning in a few minutes here, but if we go into retirement with some in each of those three buckets, traditional retirement accounts, taxable accounts, Roth accounts, we're more likely to have financial success. Look, it exists in the world, right, where we have $4 million and we're financially sufficient, but it's all in a traditional retirement account. That happens, okay? It's not the end of the world. It's not ideal, but if we can do some planning up front, maybe we can avoid that outcome. So we get to retirement and we've got $500,000 in taxable accounts. We've got, 400,000 in Roths, and we've got, 3 million in traditionals. And now we're in a little better tax planning position.
Okay, so we've gone through the basics there, but the high-income professionals do have access to a Roth. How do they do that?
All right, so there are two ways a high-income professional could use a Roth account, right? One is through the so-called Roth 401k. Now, especially if you're catching up to FI, I tend to be against that option. Look, you do you. My perspective is that high-income professional probably needs a tax deduction today and then can figure out, whether it's Roth conversion planning, just distribution planning, can sort of fight the second fight later, win the war today, get the tax deduction today. Because with the Roth 401k, you're giving up that $30,000 is shared between the traditional and Roth. So every dollar you put in a Roth is $1 you can't tax deduct. So, I generally say for the high income professional, focus largely on the traditional 401k. All right. But there's that Roth IRA. And most folks, or many folks in the audience, probably know, oh, wait a minute, there's income limits on contributing to that Roth IRA. There absolutely are. Okay. So what do we do there? Well, we might be able to do the so-called backdoor Roth, right? That's where we do a non-deductible traditional IRA contribution. That's step one. And then relatively soon in time thereafter, convert that non-deductible contribution to a Roth IRA. That's the so-called backdoor Roth. Okay. Well, why doesn't every high-income professional do that? Well, there's some hangups. The biggest hangup is they call it the pro rata rule. That's, hey, I used to work at employer A. I have $1 million rollover traditional IRA. Okay, well, that $1 million traditional IRA, generally speaking, means because of this pro rata rule that I've blogged about extensively, others have as well, I can't do a tax efficient backdoor Roth. All right, so then we get to option number 3, which would be the mega backdoor Roth, which is something I've done content around, others have as well. This is at work. So we started at regular Roth 401k. We did regular backdoor Roth. Now we're going to do the mega backdoor Roth. This is at work if your plan offers it. And a lot of plans don't, but some do, particularly in the tech sector. This tends to be widely available where, we do the 30,000 into our 401k. Great. Then in addition to that 30,000, we do after-tax contributions, and then in time move out to the Roth IRA or to the Roth 401k. And there we haven't sacrificed any tax deductions. We've just moved money from what would have been invested in taxable accounts into Roth accounts. So, Bill, I would say for most of the high-income professionals in the audience, what you're probably looking at, if you're trying to do a Roth contribution, is either a backdoor Roth IRA at home or a mega backdoor Roth at work, but both require the right profile, essentially.
Okay. As far as the mega backdoor Roth, Is that in addition to the employer contribution, or does that take the place of the employer contribution?
Great question. And the answer is it's all subject to the so-called all additions limit. That's 73,500 if we're 50 or older. So I see this with very high income professionals, or maybe like a partnership of high income professionals, legal partnership, doctor partnership, those sorts of things, where they basically just tell the partners, we're maxing out at 73.5 if you're 50 or older, both your 30,000 and then the employer contribution, and you're done. All right. So there's just no mega backdoor Roth. You just deduct the 73.5 and okay, fine. That's good tax planning, but you're done. Where I see the mega backdoor being very impactful is more the mid to upper range, executives, managers, sometimes professionals. So we're at a large W-2 employer and they offer that 3% match, that 5% match, where it's, $5,000, $10,000 a year, but that still leaves us a lot of runway. So basically what you want to do is you want to figure out your all additions limit, right? If you're 50 or older, it's 73,500 year 2023. You subtract from it the 30,000 you put in the regular traditional Roth 401k. That leaves you, my math, always dangerous doing math on a podcast, but I think we're at 43,500. Okay, then I have to look at the employer match. And maybe the employer match is $10,000. Well, now I have 34,500 that I could do in the mega backdoor Roth. So you always want to, whenever you're thinking about this mega backdoor Roth, you want to just Google, right, the 415C, that's the code section. 415C limit, I call it the all additions limit, right? But Google 415C limit, and the IRS adjusts this limit every year, 2023, 50 or older, 73,500, and then just start subtracting. Okay, I do my 30, that's a subtraction. Employer does 8,000 in employer match or 6,000 in profit sharing or whatever it is, just do the subtractions. And then whatever's left over is what you could theoretically do in the so-called mega backdoor Roth.
And that's deductible, but converted within the plan.
So the mega backdoor Roth is not deductible. It's a after-tax non-deductible contribution to the 401k. So it goes in this traditional. So you think, oh, I'd get a deduction for it. No, there's no deduction for an after-tax contribution. But what it does is it creates so-called basis. So let's just say I do 10,000 of this after-tax contribution. Okay, great. And then a day or two later, there's an IRS notice on point here that basically describes this transaction. So a day or two later, I say, oh, I got that 10,000 sitting in cash in my after-tax 401k. What I do is I just sweep that over to the Roth 401k. That's the easiest way to do it. Okay, great. I've just moved that money tax-free because I recover the basis, right? So if there was a little interest income, I do pay tax on the interest income. Let's say it's in cash, but I just moved 10,000. It was a taxable event, but I had 10,000 of basis from that after-tax contribution. It really is a nifty planning technique. It's not entirely the fairest thing in the world because only certain Americans have even access to it in their 401k plan, but that is what it is. I didn't write the rules. But anyway, so that's a very effective way, and it is not subject to the so-called pro rata rule. Now, look, if you let those after-tax contributions grow for years and years inside the after-tax 401k and then convert, and now it's worth 20,000, you'll pay tax on the 10,000 of growth. So folks like to do relatively quick in time, move from the after-tax 401k to the Roth 401k, or some employers say, all right, do the after-tax 401k and then do a rollout to a separate Roth IRA.
So we're still talking accumulation phase. Is there anything else that we need to talk about before we move to the decumulation?
So I would just say two things, right? One is a bigger picture point, which is just when you're behind, you need to accumulate. And the quickest way to accumulate is those traditional deductible contributions. Max out the traditional 401k and then take the tax savings, and hopefully you can invest that too, right? That's the quickest way to accumulate, and you can fight the tax fight later, and you're going to get progressive tax rates. So that's like big picture. I think sometimes we get lost in the weeds a little bit, and that's okay, but we just want to come back big picture, take those deductions, accumulate, and then you'll win the tax war later. But the second thing is there is an enhancement out there. And I think this is good for some, not everybody in the audience. It's called the health savings account. So that's, we have this tax triangle of the taxable, the Roth, the traditional, but we can do an enhancement called the health savings account. These only work if our only insurance is a high deductible health plan, which generally have a higher deductible but a lower premium, so we can save some money on our insurance premiums. But we subject ourselves to a higher deductible. Not everybody likes, they call them HDHPs, high deductible health plans. If you're relatively healthy, they can be very good though, because they lower insurance premiums, and then they open this door to the HSA contribution, which can be the best of the traditional and the best of the Roth. So the money is deducted on the way in, great. And then if you use it for the payment of qualified medical expenses or the reimbursement of previously unreimbursed qualified medical expenses, it can come out tax-free. So we're literally combining the best of the traditional, the deductible on the way in, with the best of the Roth, the tax-free on the way out, if we play our cards right. And for those who are relatively healthy, this is something to keep in mind. If you have a very serious chronic condition, a high deductible health plan probably isn't going to be the right answer. Do your own research, do your own analysis. But for those who are relatively healthy, particularly those in the audience who are relatively young, and I know Becky and Bill, you guys have built up quite an audience that has a lot of younger folks too, especially for those younger, healthier folks, the high deductible health plan coupled with the HSA can be very impactful.
So we've got all these accounts and it seems so complicated, but we need to know sort of an order of operations, sort of in what order do we fund these accounts to reach maximum benefit? What comes first?
Yeah.
And how does the money flow?
Yeah. So I would say the first thing you're going to want to do is capture the employer match inside the traditional 401k, right? That is as close to free money as we get. I know we have to go to work, but it's certainly as close to a guaranteed return as anybody's going to get, right? So we got to capture the employer match inside of the 401k. And then I think we have to think about, are we catching up to FI or are we younger? If we're catching up to FI, step two, maybe just max out that traditional 401k, keep that growing, and then focus on things like HSA, Roth IRA contributions, and then focus on things like growing those taxable accounts. I would say that's what's going on there. I think if you're younger, you start off with that capture the employer match, and then you go, instead of fully funding maybe the 401k, you go more towards, hey, I'm going to max out the Roth IRA at home. I'm going to make sure I get the HSA funded. Then maybe you go back to, all right, now I'm going to top off the 401k, and then we go to taxable accounts. But different circumstances mean different things. So I'll give you an example from my own life. I used to, I'm a career changer. Before I was a financial planner, I worked in Big Four accounting. And so I was thinking about being a career changer. And so I, back then, focused a little more. I always captured the employer match, but I focused a little more on building up my taxable assets, because I was thinking, hey, I'm going to start a business and I'm not going to have the regular W-2 income. So I want a little bit of cushion in the taxable accounts. That was just a unique situation that pertained to me at that time. So you got to look at your own unique situations. But if we're just sort of high level for many folks, especially if we're younger, employer match, then Roth and HSA, then back to the 401k, then back to the taxable accounts.
For the younger audience here that we do have, can you talk a little bit about the story we always hear about saving in your 20s, maxing your Roth, and then you do it for 10 years and stop? How does that compare to the person that starts 10 years late and saves for the rest of their life? And how did the two end up in that hare and tortoise race?
Yeah, Bill, I mean, the thing about it is the one thing I can't buy you is time, right? In theory, I can come up with scenarios where you get, compensation like crazy. I can make you the next big superstar in movies or sports or music or the sciences or whatever it is. But the one thing we can't buy is a minute of time. We just can't buy that, right? So if we can get that money in earlier and earlier, we're going to have more success in terms of building up, a tax advantage wealth. That's like the big thing is can we build up, the sooner we start building up wealth, the more likely it is we're going to be able to meet our retirement goals. And so, there's those, mathematical analyses. Depends on your, what rate of return you use, but sometimes investing from like 25 to 35 and stopping can be more impactful than investing from, say, 35 to 55 or 35 to 65, depending on, investment returns and things like that. So getting the money in there sooner is going to work to your benefit. It's just the way it works. And compounding interest, one of the greatest, forces on earth. And the quicker you get the money in there, the better it's going to be, especially if you can do it in a tax advantage way, right? If we can get, $5,000 in a Roth IRA at age 25 is going to be a lot more impactful than $5,000 in a Roth IRA at age 55. Not that maybe you shouldn't do it at age 55, but every little bit helps, but little bit helps more the younger you are.
The reason I bring that up for our older audience is if they do reach sufficiency and have kids and they have earned income, when you want to give wealth while you're alive and make a difference for them in their younger years, you can actually match them on their earned income and put it in their Roth, correct?
Yeah, so let's talk about that. A young, there's no age minimum on the ability to contribute to a Roth IRA. Canada actually has that in their version of the Roth IRA, but the United States does not. So that's one thing to keep in mind. Two, anyone with earned income can fund a Roth IRA. Any American with earned income can fund a Roth IRA. But three, the source does not have to be the W-2 check of that person, right? So let's say you've got a 25-year-old adult child. They're in their first or second job, and they make $50,000, whatever they're making, and they're able to fund their living expenses. They contribute to their workplace 401k. They qualify for a Roth IRA, but maybe they don't have the $6,500 lying around to max it out. You can send them a check and say, hey, Junior, put this in your Roth IRA. That can absolutely be gifted to them. What I tend to say about that is you always have to, what I would say is focus on your own goals and your own sufficiency first. And only when that's been met, not when you're on the path to meeting it, start doing tax planning for your kids. One thing to keep in mind too is your kids, when they inherit your wealth, usually get a step up in basis in the taxable assets, can inherit Roth accounts and have 10 more years of tax-free growth on those things. So keeping assets in your own name can actually be very powerful tax planning for your kids. So that's, I think sometimes in the FI community, we overemphasize some of the tactics around, put $5,000 in your 10-year-old's Roth IRA and it'll be $1 bazillion when they're age 90. I think we need to rein that in a little bit. But that said, you absolutely can be thinking about, hey, I'm a financial sufficiency perspective, and my kid's a teacher and 26 years old, and it's a little tight. And yeah, absolutely, send them a check for the $6,500 and say, hey, Junior, hey, daughter, whatever it is, hey, put that money in a Roth IRA, and trust me, you're going to be very happy it did in 30 years.
And to kind of circle back to something that you said, Sean, Stephen and I accidentally ended up in a place that has been very advantageous to us on that tax triangle, because we didn't have access to 401k, and because when we finally started saving, Stephen's salary soon thereafter got high enough that we didn't have access to some of the other, we couldn't contribute to a Roth and whatnot. And so just by accident, we ended up with money in Roth IRAs, traditional IRAs, and taxable brokerage accounts. And not even knowing that was a goal that we should be shooting for. But I'll tell you that in retirement, it has been so nice to have some money in all of those places, because it does give you flexibility. And we've been able to we don't have real estate or side hustles. We're strictly living off our investments. So we have the ability to somewhat control our income, which has given us the ability to do Roth conversions. Stephen's not going to take his Social Security until age 70. And so in between when he retired at 63 and age 70, we're doing as many Roth conversions as we can to keep our income in that 12% bracket, which gives us free long-term capital gains. So it's been really it's been eye-opening to learn all of this and then realize that we've been able to do some of this. So let's move over to decumulation or drawdown when people do start living off of the money that they've saved. So what do we need to know about that?
Several things, right? So I think for most in the audience, one of the principles I like is spending taxable assets first in retirement, particularly in early retirement. So there's several reasons I say that. Becky, you alluded to in your own circumstance how your income's been relatively artificially low, and that's great. One of the advantages of spending down the taxable assets first is it's a way to help guarantee that will be true, right? So Moses did not come down the mountain with an 11th commandment stating we shall always have qualified dividend income rates. And he also didn't come down with an 11th commandment stating we shall always live in a low yield world. So in theory, what could happen to, say, Becky and Stephen, and I'm not giving them a particular advice here, but in theory, they could be holding some taxable assets and the tax laws could change, right? And so now we have ordinary income tax on their dividends, and then maybe yields go up and all of a sudden they're collecting 6, 7, 8% dividends every year. And now Becky and Stephen have a bit of a problem, right? So I like this idea of maybe for folks like them, spend down those taxable assets first, because the taxable assets kick off what I refer to as uncontrollable income, right? If you own $500,000 in XYZ mutual fund, in December, it pays a dividend. And that just is what it is. You don't get to call the financial institution and say, hey, can you not pay so much dividends, right? So I like that idea. Second thing it does is, we haven't talked about this, but creditor protection. This is something I like, where assets in traditional IRAs, 401ks, Roth IRAs enjoy varying degrees of federal and state creditor protection. So, but taxable brokerage accounts, generally speaking, no creditor protection. So I like the idea of, in the beginning of retirement, we spend down the unprotected assets, right? And then we let the tax advantage, relatively speaking, creditor protected assets grow. We're giving ourselves more creditor protection because we're not spending those things down. Folks should look into things like personal umbrella liability insurance as well. But I like the idea of spending down the unprotected assets first and allowing the creditor protected assets to grow. Okay. The third thing is those Roth conversions you mentioned, Becky. So, somebody like Becky and Stephen might get to retirement 63. Oh, look, I got a big old 401k. I'll start going to that. And so now the grocery bill and the heating bill and the gas bill and whatever it is, that all just goes to the 401k. Well, why not pay for that with the taxable assets and then separately do those Roth conversions? So what we're doing is we're taking our old traditional retirement accounts and we're letting them move over to Roth. Maybe we do pay a little tax, but maybe when we were working, like I said, we were at 24, 32%, whatever. And now maybe we're only in the 10%, 12% bracket. I think when we're in our early retirement, we want to sort of, in the fourth quarter, go through our sort of mock up, folks can use Excel or Google Sheets, sort of do a mock tax return, just add up all my income for the year and sort of estimate what December is going to look like. See what the standard deduction is going to be in most cases. Some people might itemize, but most people are going to be doing the standard deduction and sort of come up with, all right, what's my taxable income? How does that compare to the 10% bracket, the 12% bracket? Maybe I've got some runway there to, before year end, affirmatively do a Roth conversion, right? So affirmatively create taxable income, but do it when my tax income, my tax rate's relatively low. And now I'm getting that money out of, there's a gentleman, Ed Slott, very famous in the personal finance space, from forever tax to never tax, right? But it's a good point, right? It's a very good point. Let's get that money into Roth when we have the opportunity. Let's be opportunistic and get that over there then. One thing just to keep in mind of those, two things to keep in mind, the Roth conversions, not reversible, right? It used to be you could reverse a Roth conversion. Now you can't. So I like doing it in the fourth quarter when we have a good understanding of what the year really looks like. But two, the deadline is December 31st. So people get confused by this. Oh, I can make a traditional IRA, Roth IRA contribution up to April 15th. Absolutely true, right? You just code it at the financial institution for the prior year. Great. Roth conversion cannot be done that way. Roth conversion happens when it happens, period. So if it happens on December 30th of 2023, it's a 2023 Roth conversion, end of story. If it happens January 2nd, 2024, it's a 2024 Roth conversion, end of story. So I think that's those are some initial parameters in terms of planning for this decumulation, spend down, whatever you call it, phase, where the tax planning can get real exciting and can get us more towards these Roth accounts and being able to sort of control our income.
One of the things that I like to try to keep in mind is most of the time when people are talking about taxes, they're trying to reduce their taxes today. And in retirement, really, you need to look down the road. There are times, like with these Roth conversions, where I'm going to choose to pay some taxes today because I can minimize taxes in another year, possibly. So you have to look further down the road than just this year.
Yeah, I think there's some learning to be done here. So, if you filed your tax return last year and you reported $30,000 of income and took a $27,000 standard deduction, whatever it is. So you showed $3,000 of taxable income and you got a $2 million traditional IRA over there. You missed out on an opportunity, right? You probably should have been doing some Roth conversions, right? You got to do your own analysis. But what I'd say is always look in the fourth quarter. Okay, what's my income? What is my deductions? Probably going to be the standard deduction, but that can vary person to person. But all right, is there an opportunity here to move some of that traditional IRA over to a Roth IRA at a relatively low rate? By the way, it is possible to do in-plan conversion. So maybe I still have an old traditional 401k. Maybe I do a Roth 401k conversion inside that thing, right? That's a possibility as well. But yeah, there's absolutely opportunity on the table, particularly before two events, before we take Social Security and before we have to take our required minimum distribution, right? So depends on the age of the person in the audience. It might be 73, might be 75, but at some point the rules say from those old traditional retirement accounts, IRA, 401k, you have to take the money out based on an IRS table. It generally increases as we age. So why don't we, before we have to have this income, why don't we take some opportunities to move it over to the Roth when the getting over is good? Because we're at an artificially low tax rate. We're not collecting Social Security. We're not collecting RMDs.
Mm-hmm. So there's a few other items that we can talk about that may be new to our audience. The rule of 55 and 72 T's. So what do those numbers mean?
Yeah. So now I will say these ones tend to be less for those catching up to 5, but it could apply. It certainly can apply to those who retire early. So it does exist in the world that, people come to the Catching Up to 5 podcast and they've listened to one personal finance podcast in their whole life. They have no idea about 401k, IRA. They have a lot of money, and maybe they have a lot of money in their 401k because generous employer contribution, employer stock that went through the roof, whatever it is. There are different things that can happen where you get to say 53, 54, 55, 56. And you've got a boatload in your 401k, you got $10,000 in the bank account, a paid off house, and that's it. So you got a person who is great from a sufficiency perspective, but they're looking and they're saying, well, I'm not 59 and a half. If I start accessing this money, I got to pay ordinary income tax and the 10% penalty. That don't sound too good. Well, there are options on the table, right? One option is they call it the rule of 55. So I've got enough to retire on, but it's all trapped in a 401k. All right, well, if you separate from service in the year you turn 55 or later, right? So it's this odd thing. You could theoretically be age 54 and still get this exception. You have to look at when do you separate from service, not when you take the distribution. If you separate from service in that year 55 or later, you could take the money from the employer plan penalty free. You still pay the tax on it, but it's a way of, hey, I got to fund my life, right? So I could do that. Now, the big thing is you got to keep the money in the plan. You can't roll it to a traditional IRA. The second it goes into a traditional IRA, no Rule of 55 exception. Okay. But that only applies, again, if you're at least 55 sometime in the year you left service, right? So what if I'm 53, 52, I got 5.2 million in my 401k profit sharing plan, whatever at work, and I'm just not happy anymore, and I've got plenty to retire on. But what do I do there? Well, the answer there can be either leaving it in the plan or rolling to a traditional IRA and doing what they call a 72T payment. This gets a lot of buzz online in the early retiree community. And what this is you're basically agreeing with the IRS to take a set amount of money from a retirement account every year for the longer of 5 years or to when you reach age 59 and a half. So if you're 35 out there, a 72T plan is probably not going to be that great because you're going to be doing it for 25 years. But if you were 53, 52, even 56, 57, 58, and you just got a bunch of money in a traditional IRA, you can do a 72T plan. They require some math. There are online calculators out there. I can't vouch for any of them. I just haven't back validated any of them. Oftentimes it makes sense to work with a tax professional. The good news is it's a way around that 10% penalty. You still pay the ordinary income tax, but it's a way around the penalty. The other good news is you can right size IRAs to get the right payment amount. So maybe you have a $2 million IRA and you do the math. And if you just took it from the full $2 million IRA, you get, say, a $100,000 payment, but you only need $40,000. Well, you could call your financial institution. All right, take IRA 1 and make it IRA 2 and 3, one with whatever amount you need in the 72T payment, and then the other one that's not for the 72T payment. You absolutely can do that to sort of right size to get the right 72T payment. And then, but the bad news about it is it is a little inflexible, right? So you have to take the same amount of money every year. So folks don't like that aspect of it. But these are two bailout techniques when we're before age 59 and a half that can help us, live our early retirement when we don't have the best balance sheet from a tax perspective to be early retired.
My understanding with the 72T is actually there's 3 ways to create your payment. And I didn't know that before, but you can adjust your payment to the lowest version, the highest version, or a middle version. What are those 3 ways?
Yeah. So, and this is something I actually have not spent a lot of time on. The most common method is, I believe it's called the fixed amortization. I actually have a blog that goes through it, which it sort of looks like a mortgage payment. What you do is you take the balance in the account, you take an interest rate, which is either, generally speaking, 120% of the adjusted federal midterm rate, or anything from 0.01 to 5%. So the IRS came out with a rule in early 2022 that now says it used to be you had to look at that 120% of midterm AFR, I believe, and that was the rate. That was it. Now they say, well, you can look at that, or you can look at any rate from basically 0 to 5 at any time, regardless of what the rates are in the world. So this really helps folks. And basically what you're doing is it's almost like a mortgage amortization calculation. You look at the balance in the account, the interest rate that you've picked, either the 120 of AFR or midterm AFR, or the anything from 0 to 5. So then the other input is your expected remaining life expectancy from an IRS table. You basically put that in like it's a mortgage, and you get the payment, right? And there's something called IRS notice. I think it's 89-25. They've got a question and answer where they actually compute it. And so you can sort of back validate your computation there. But there are 2 other methods. One is an R&D method, and that method is a little more difficult because it changes it every year. And I'm forgetting the third method, to be honest with you, Bill. The IRS has documentation on this. This is the sort of thing you definitely want to work with a professional on. The most common method, to my understanding, is that fixed amortization method, because that produces an even, consistent payment. The other thing you can do, like I was saying, well, you can right size so that you can have, one account for 72T of a certain size. Well, if you get to a place where that's not sufficient, you can then right size the remaining account into 2 accounts again, and then create a second smaller 72T payment to make up the difference, right? So there's some flexibility there. If we have a sufficient amount of wealth, we can create, basically a 72T account and a non-72T account. But then later on, if we have to increase the payment, we can play around with that non-72T payment account to right size that, to create a second 72T payment account.
Great. So the last thing that we wanted to touch on was Social Security. And we could spend hours talking about Social Security, but what I'd like to do is just maybe talk about some basics. And Sean, what's your opinion about how a late starter needs to look at Social Security?
Yeah. So Social Security is an important part of Americans' retirement, and especially a late starter, someone who is already in their 50s or 60s, should realistically expect to collect Social Security and should include in their analysis, right? So a lot of us come to this from the financial independence community perspective. And so, hey, I'm going to early retire. I'm not even going to think about Social Security, which is actually sort of a valid assumption, because if I'm going to get to retirement at age 53 or age 58, I can't collect Social Security at that point. Why am I factoring it in? Now, yes, later on I will. And I refer to it as one of the backstops to the 4% rule. That's a different conversation. But if we're already 59, 60, 61, we should think about, look, Social Security is going to be there and it's going to pay me significant benefits. So now it's looking at what is my earnings record. You can get that from SSA.gov. Now, I will say SSA.gov statements tend to be somewhat opaque, right? So you can pull your earnings record and you can do some calculations. I have a blog post on this about what it could look like in terms of your benefits in retirement, but it's absolutely there and it's something to think about. I will say deferral often makes sense, but there's no silver bullet in this regard. So, what I mean by that is a lot of times, especially in a married couple, it makes sense for that higher earner to defer to age 70. But that's a theoretical point. We don't know when you're going to pass. So that's something, if we knew that, we could absolutely make some calls there. The other thing is we don't really know officially the investment returns you're going to make. And so, but deferring Social Security is electing into it some investment return. So you can take Social Security, generally speaking, as early as 62, but you can defer it, generally speaking, to as late as 70. Deferring it increases the annual payment. So it's like getting an investment return. From ages 67 to 70, that's 8% a year. That's a good investment return. But, in theory, this is just theoretical, right? But, in theory, if you had an investment portfolio that was generating 15% a year, right? Just in theory, when do you take Social Security? The answer is as early as possible, because you want to live off that Social Security first and let your portfolio keep generating 15% a year, because Social Security, maybe we love it and it's generating 8% a year at max. So there's no silver bullet in this regard. Look, if you're going to live to 115, folks generally like to defer to make that annual payment as large as possible. But yeah, I think Social Security is an underappreciated piece of retirement in the financial independence community. And if we're a little later in life in our working career, we got to be realistic about our financial planning, and that's on the table.
I want to add to my audience, or our audience, that there is a calculator that's been put together by Mike Piper, a real advocate in the financial independence community. It's called opensocialsecurity.com. It is free, and it really takes you granularly through when and how you should take Social Security. I would like to recommend that.
Yeah, Bill. So I cannot personally validate, I haven't back validated Mike's work, but I can say Mike puts out excellent things. And so, in terms of an educational resource, Mike Piper's website is fantastic and is something to at least think about.
Great. Well, I think we have covered everything that we wanted to today. It's been a lot of information, but I think that it's been great, especially for our audience of late starters. And I want to remind people that, as Sean said, as we were talking through this, he's got blogs on his blog of FITaxGuy.com. that address a lot of the things that we talked about today. So if you want to understand it better, or you just need to dig deeper in the weeds, be sure to check that out. Check out his book, Solo 401k, the Solopreneur's Retirement Account. That would be a great resource for anybody that is a solopreneur. Sean, I can't thank you enough for walking us through a lot of this tax stuff today, because in our late starters accumulating phase and in our drawdown phase, the taxes are always something that we need to keep in mind, but sometimes we just don't really, it doesn't bubble to the top of importance, but it is something that we need to talk about. I thank you so much for walking us through all of this.
Becky, Bill, thanks so much for having me. Really enjoyed the conversation today.
Yeah, it's good to pay taxes when you have the income. It's also good to pay as little as possible and play the game properly. We've tried to light your fire in order to dig deeper into these things. We haven't tried to overwhelm you, but we hope to be a resource that gets you to dig deeper down the rabbit hole. Thanks again, Sean, for joining us today. It's been awesome. We hope you've enjoyed this episode of Catching Up to 5. We would appreciate it if you could leave a 5-star review so that our message can reach others.
We are not lawyers, financial advisors, accountants, or tax experts. Please consult your own professional advisors before making any important decisions. Our content is for entertainment and education purposes only.
We'll see you next time on Catching Up to 5.